Bitcoin has a set of properties that are unique to Bitcoin, and then it has some properties that I think we've seen before, not in gold, but in other crazy speculative bubbles. This one Bitcoiner on Twitter said to me, "Go study history" or something like that. And what he meant is, last year or 2 years ago, Bitcoin crashed and then it recovered. And so he's highly confident Bitcoin's going to be $100,000. And I said, "Oh, do you mean like 1636 and 1717, referring to Tulip Mania and the John Law, Mississippi bubble, respectively?" And Bitcoin has a lot of aspects like that. It has an interesting story. The story morphs over time. More people buy into the story keeps morphing. And then eventually, once everybody's all in, there's nowhere to go but out. And then, the price crashes and, the end.
Yeah, it's a fascinating period in history, because I do think the right analogy is to think about it as a competition, not for gold, because it lacks that core commodity characteristic where it ceases being somebody else's liability. Once I have it, I can do with it whatever I want. I can stick it in a drawer, I can stick it in a warehouse, I can convert it into copper wire, I could do whatever I want. When I have a commodity, I can run it through a refining operation and turn it into gasoline, which functionally has value because of the density of storage and its use in internal combustion engines. But it doesn't require anybody else to do anything, right? I could buy my oil and NYMEX could shut down tomorrow, right? You could eliminate the trading of oil and I still get to use it, right? I still get to use that oil. It might, actually, paradoxically, might become increasingly valuable under that scenario, right? So when I think about that, it then focuses me back into, we have maybe a very different world. For me, gold had value primarily because it was the adopted monetary policy of many nations around the world for an extended period of time, right? It was respected as a tool to prevent various forms of counterfeiting and excessive seigniorage by kings, princes, queens, etc. throughout history. What would it take to see gold return to that type of role? Do you think it can return to that type of role at the center of a monetary system?
I think it's inevitable, and the only question is what path we take to get there. So a big part of my argument about falling interest rates and exponentially rising debt is that the system has a finite end that is coming. If the problem were simply inflation, which is more quantity of dollars and more rising consumer prices, that doesn't necessarily have an end. I mean, that's been going on for well over 100 years. There's no reason why it couldn't go on for another 100 years or 1,000 years. But the rise of debt and the collapse of the interest rate are both trends that can't be sustained forever. And so if we stay on the current trajectory, we get to collapse. Civilizations have collapsed before. Weimar Germany, the whole civilization doesn't collapse because the countries around it had not been so crazy as Weimar Germany was. But Rome collapsed in 476 AD, and that was the collapse of, greater part of the known world. Or alternatively, so my company, just to plug for us, we're trying to bring gold back into that role by paying interest on gold. And we do that not like these crypto DeFi schemes of essentially selling it short and, trading schemes, but actually by financing productive enterprise, productive businesses that are using the gold and financing them. But either way, the dollar is failing. That's pretty clear. And then a lot of people are arguing over which paper currency would replace the dollar. And they argue there's no other paper currency that is remotely close to being able to replace the dollar. And they're all USD derivatives anyways. But gold is the one thing that can replace it. And the question is, does it do so, i.e. post-collapse, or does it do so because there's some sort of graceful transition, which I think is a lot better for those of us that are likely to have to live through that.
Yeah, I mean, my gut tells me it's collapse rather than graceful, but explain what you mean when you say you pay interest on gold without the shenanigans associated with the trading activity. What does that mean? How do you get interest for a metal that you're simply storing?
Well, we're not simply storing it. We're actually either leasing it or lending it. So we have two different programs to businesses that need it. So for instance, if you're a jewelry manufacturer and every day you buy a kilo bar of 4/9 gold, and then you have a production process that involves squashing it under rollers, cutting out little shapes, bending them, soldering them, polishing them, grinding them, and so on. And then at the end of 2 weeks, you spit out a kilo of finished gold jewelry product. If that's a 2 week process, you have in my example, you have 14 kilos of gold that's always in the pipeline. Every day a kilo coming in. You have a 2 week long pipeline, every day a kilo going out, but 14 days contained. You have 14 kilos. You have to finance that inventory somehow. The conventional way is you borrow dollars, you buy your 14 kilos worth of inventory, roughly $1 million, something like that, if my math is right. And then you have to hedge, because if the price of gold were to drop 10-15%, you're bankrupt. So you have to hedge that price risk by leasing the gold. It makes the whole financing thing have less risk, less moving parts, less complexity, and less cost. And the owners of that gold, the jeweler is happy to pay interest on that because they're getting finance that they need. And that's how we pay the owners of that gold earn interest on it.
How do you think about scoring credit risk in that sort of scenario? Because that's effectively, I mean, you're effectively making a secured or an unsecured loan. Are the documents secured? Do you have first claim on that gold getting it back, or is it an unsecured loan?
It's a lease, so it's not on balance sheet of the lessee. So if they were to declare bankruptcy, we just simply repossess. Like you lease a car from GM, that car isn't sold to satisfy the creditors. GM just simply repossesses it. But you're absolutely right. Number one, and we say this to everybody, there's no such thing as a return without risk. If someone's promising you a return and that the other side of their mouth is promising no risk, run fast and far, because that's not right. There is risk. And then the question is, how do we measure it? How do we do our underwriting? Yes, the answer is yes, we take that very seriously. There's a lot that we do to not only do our due diligence, but an ongoing monitoring compliance program to make sure that the gold stays there and that nothing goes bad 6 months, 8 months down the road.
So when you think about the metrics that I would want to see on a credit report like that, I mean, do you track things like charge-offs? Do you track things like prepayment activity, et cetera? Are you running, I mean, you're effectively running a small business credit operation, correct?
Yeah, we absolutely look at the business credit. We want to understand their balance sheet. We understand everything. Now, there are some deals that the gold is not in their custody, and so that stuff matters less. So for instance, a jewelry retailer may have a whole bunch of gold product in a Brinks facility, and then they're shipping it to the customer when the customer buys it. So there's a little bit less concern about their balance sheet, and obviously more concerned about just operational controls. Who can direct that gold be shipped, under what circumstances, and and so on. Yeah, absolutely. You have to reckon with the risk, and you have to do everything you can to discover it, to mitigate it, to control it. I don't mean to gloss over any of that.
Yep.
But the point being that we're bringing gold back into productive use, and I think a good, solid working definition of a gold standard is when anybody who chooses to, so you have the right but not the obligation to deposit your gold, can earn interest on their gold in gold. When that condition is true, you have a working gold standard. And that's what we're working to do. That's what happens when we scale up.
If you were to lay out kind of what you expect to happen over the next year as we see the Federal Reserve hiking interest rates, shrinking the balance sheet, do you think, what's your kind of macro point of view? Do you see gold well positioned under that framework, or do you think that gold faces significant risk, and by extension, Bitcoin?
So, we put out our gold outlook report at the end of January. So that was before Ukraine was certainly on my radar screen anyway.
Yep.
And I said that this year was the toughest year after writing this thing for over a decade. This was the hardest year by far to make any predictions because the Fed is seemingly hell-bent on hiking rates. And if they proceed with that, then they're going to precipitate a crisis and all sorts of calamity. And in that case, that is certainly not bullish for the price of silver, because we also, track and analyze silver. But gold is more of a mixed bag because for every party who's selling gold because they have to liquidate everything in order to meet margin calls and whatever, there's somebody else buying gold because they don't want to be a creditor to increasingly unsound, things. And so, as we're seeing the dollar, skyrocketing on the dollar index, the interest rate in dollars is now more attractive relative to the other currencies than it had been. But the thing that makes this so hard is it's kind of a political decision how much pain they're willing to tolerate before they reverse course and say, well, maybe we don't really mean it. Or, that's the ticket. We really meant to hike, but, now that Ukraine happened, we get to preserve our reputation and our credibility, but we're going to reverse course and go right back to zero interest rate policy. They're going to have to. The entire macro trend for 4 decades and the forces and drivers are still in effect is a falling interest rate structure. So what is it? So that's number one point. Number two, destruction occurs at the margin. It's not like the economy is fine, the economy is fine, the economy is fine, click, the economy is not fine. What happens is most people aren't necessarily aware of the damage until it accumulates, it rises above a certain threshold. Then everyone says things aren't fine, but you're causing damage all along the way, or in this case, precipitating. We won't even go into that the damage was actually caused as the interest rate was falling. So when does the crisis or calamities in aggregate rise above the threshold that the Fed has to pull the plug on this so-called program of hiking rates and reverse course? And that's a political decision. A lot of people are looking at, well, we have an election coming up, not too far down the road. And is the party that's in power going to be happy to allow the economy to be tipping into recession and, people not only losing money on their stock portfolio, which is one thing, but losing their jobs, which is another. Are they going to be happy to have that being the dominant story in the news cycle at the moment they're going into an election? Usually elections are not kind to the incumbent party when the economy is going into recession. So will they put pressure on the Fed? Will Jay Powell be subject to that pressure? What is Jay Powell actually responding to? I don't think he cares about GDP. I don't think he cares about stock prices. I think he cares about bank solvency. And so when the banks are starting to see rising defaults, do they call up Jay Powell and say, we gotta reverse this? What happens when the yield curve inverts decisively in a much bigger way than it has, so far? These are the things that the Fed can see. But anyway, it becomes a very political decision as to what they're going to do. And, I don't know how to predict that any more than the next guy. But what I can say is that the trend for interest rates is down. The Fed can only play at fighting that for so long and only drive it so far away from its trend line. And that I'm bullish on gold from here because I just see more and more people having more and more reasons to own it to escape, the system.